In 2008, the global financial system came dangerously close to collapsing. Banks that were considered too big to fail, failed. Stock markets crashed. Millions of people lost their homes, jobs, and life savings. And the most shocking part? This crisis didn't start with war, oil, or a natural disaster. It started with home loans. Today, we're going to break down exactly what caused the 2008 financial crisis, how it spread across the world, and the lessons it left behind. Part 1. The American housing boom. In the early 2000s, the U.S. housing market was booming. Interest rates were low. Homes were getting more expensive every year. Owning a house was seen as a guaranteed path to wealth. Banks wanted more people to buy homes, so they started giving out loans to borrowers who normally wouldn't qualify. These were called subprime mortgages, loans given to people with low income, poor credit history, little or no documentation. Some loans even required no proof of income or employment. They were nicknamed ninja loans: no income, no job, no assets. The logic was simple but dangerous. Even if the borrower defaults, housing prices will keep rising, so we'll recover our money. But this assumption would soon prove fatal. Part 2. The problem with adjustable loans. Many of these home loans had teaser interest rates. For the first few years, the ME was very low. But after that period ended, the interest rate reset sharply higher. Borrowers were not prepared. They were betting on one thing: that they could refinance later because home prices would keep rising. But once interest rates increased and housing prices stopped growing, refinancing became impossible. Defaults started quietly at first, then they exploded. Part 3. Financial engineering, turning risk into gold. Here's where things get really dangerous. Banks didn't keep these risky loans on their books. Instead, they packaged thousands of mortgages together and sold them as investment products. These were called mortgage-backed securities, MBS, collateralized debt obligations, CDOs. Imagine mixing good loans and bad loans in a single box and selling it as safe. Rating agencies gave many of these products AAA ratings, the highest possible safety rating. Investors trusted these ratings. Banks trusted the math. Everyone trusted that housing prices would never fall nationwide. That belief was wrong. Part 4. Leverage, the silent killer. Banks didn't just invest their own money. They borrowed massive amounts to invest even more. Some investment banks were leveraged 30 to 1. That means, for every 1 rupee of their own money, they borrowed 30 rupees. When prices were rising, profits looked huge. But when prices fell even slightly, losses became catastrophic. A small decline wiped out entire balance sheets. Part 5. The housing market collapses. By 2006-2007, home prices started falling. Borrowers defaulted in large numbers. Foreclosures flooded the market. As more homes were sold cheaply, prices fell even further. The value of mortgage-backed securities collapsed. Assets that banks thought were safe suddenly became toxic. No one knew how bad the damage really was. Part 6. Bank failures and panic. In 2008, the crisis went mainstream. Bear Stearns collapsed and was sold in a fire sale. Then Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. This shattered confidence. Banks stopped lending to each other. Credit markets froze. Even healthy companies couldn't get short-term loans. AIG, one of the world's largest insurance companies, was rescued at the last moment to prevent total collapse. Fear spread faster than the crisis itself. Part 7. Global contagion. The crisis wasn't limited to the U.S. Financial institutions across Europe and Asia had invested in U.S. mortgage securities. Stock markets crashed worldwide. International trade slowed. Unemployment skyrocketed. Governments had no choice. They injected trillions of dollars into the system to stabilize banks and protect depositors. The world narrowly avoided a second Great Depression. Part 8. Aftermath and Lessons. The 2008 crisis changed global finance forever. Key lessons. Easy credit creates hidden risk. Complex financial products can disguise danger. Excessive leverage is deadly. Regulation is essential, not optional. New banking laws were introduced. Capital requirements increased. Risk oversight improved, at least on paper. But the core lesson remains timeless. Markets crash not because of one mistake, but because many people believe the same dangerous story for too long. And with that, we can clearly conclude that the 2008 financial crisis wasn't just a financial failure. It was a failure of judgment, incentives, and responsibility. And it reminds us of one hard truth. When everyone believes something is too safe to fail, that's usually when it fails.